Has the US hit the soft landing of controlling inflation without a recession? Not yet, but we've done surprisingly well, BU economist Adam G says. Now, this article says U.S. policymakers have spent 2 years seeking a soft landing for the economy, taming inflation without plunging the country into recession. After a series of interest rate hikes by the Federal Reserve, inflation stands at an annualized 2.5%, just above the Fed's target of 2%, and we're celebrating 2+ years of joblessness below 4%. Now, technically, a recession will require 2 straight quarters of economic contraction, which we've not had. Whether or not the nation's economy has achieved the devoted wish for a soft landing could determine the outcome of this November election, etc. Now, there's lots of different analysts and investors that think that we might have made it out of all this craziness without a recession, but there's other investors that are positive that towards the end of this year, and if not early 2025, we're going to see a massive recession on our hands. But either way, in this video, we're going to go through 5 different single stocks that not only are all potentially offering a massive buying opportunity because where they're trading at as of right now, but also on top of that, every single one of these stocks during the most recent recession, I'm talking 2008, not only maintained but even increased their dividends historically. So if you're a dividend investor that's looking for some potential safe havens when it comes to the up and coming recession that some people think is right around the corner, well, make sure to stick around, drop a like down below, and let's go over the first stock. Real quick, for those that haven't already, make sure to go to the first link in my description and grab my new dividend investing ebook, where I share exactly how I went from $0 invested to now earning over $6,000 on a monthly basis and over $1 million invested in the markets. Along with the ebook, you're also going to receive my custom dividend tracker, where you can track your dividend progress on an ongoing basis and reach your dividend investing goals. So make sure to grab yourself a copy of my dividend investing ebook and the new dividend tracker today. It's the first link in my description. So the first single stock that not only could be offering a potential massive buying opportunity because once again where it's trading as of right now, but also this stock maintained and even raised their dividend during the most recent recession, which is what we're all looking for. We're talking about Nike, or ticker symbol NKE. Now, it's no secret that Nike has been beat up like crazy over the last year or so, and as of filming this video, it's trading at just over $70 per share, offering a 2.01% forward dividend yield, which is basically double the starting dividend yield that investors have received over the last 5 or so years. Now, Nike's dividend safety score is 99, so obviously this single stock offers a very safe dividend. Now, even if Nike doesn't offer the largest starting dividend yield, it does have some massive dividend growth historically, and like we said, the dividend safety, which is definitely worth something. But most importantly, in the context of this video, Nike during the most recent recession, we're talking 2008, 2007, 2009, that area, Nike actually increased their dividend during this time period, which probably made investors feel very, very good considering everything around them was basically melting. Not only that, but Nike also had recession sales of minus 6.6% and recession return of minus 36%, which is actually a better return than that of the S&P 500, which again, during this time frame, pretty much everything was melting. But I say all that to say that Nike could be a good opportunity as for now, like I said, where it's trading, and also just going off of the previous recession, not saying that what happened in the past is going to happen in the future, but Nike honestly held up pretty good. Another single stock that's offering a potential buying opportunity because of where it's trading as of right now, and also a single stock that made it through the last recession with not only leaving their dividend alone, but also potential dividend increases, was Bristol Myers, or BMY, which is currently offering a 5% forward yield, almost double that of the 5-year average, which makes Bristol Myers a potential buying opportunity for investors that want some exposure into pharmaceuticals. Now, the dividend safety score for Bristol Myers as of right now is 70, so across the market right now, it's relatively safe. There's probably not going to be a dividend cut, at least going off of Simply Safe dividends measurement. But also during the most recent recession, although Bristol Myers didn't necessarily increase their dividend, it does show that they maintained their dividend throughout the most recent recession, with the recession return of minus 32%, recession sales of minus 20.9%, so it once again held up much better than other stocks and even other ETFs across the market during the most recent recession. Now, who knows what's going to happen if we see a recession coming forward, but last time it held up pretty dang good. Another single stock that's not only offering a potential buying opportunity, one that I've been watching closely, but also held up during the most recent recession is CVS Health, or ticker symbol CVS. Now, CVS is offering a 4.45% forward yield. The average yield is around 2.89%. So buying into CVS right now, if you're willing to take upon that risk, again, this is a space that I'm sort of staying away from ever since I bought into Walgreens, and that did not end up that well for me. But CVS Health is offering almost double the starting yield, almost 5% starting yield, which is an accidental high yielder potentially. Also has some pretty fast dividend growth historically, a safe dividend at that, an 80 on the safety score. But also, most importantly for the context of this video, CVS Health actually increased their dividend. This was during 2007, and this was during 2007 to 2009, and recession sales are minus 2.5%, which again is above average, and also recession return was minus 38%, which was also above average. Now, is CVS Health the same exact company, the same exact stock that it was back in 2008? Well, probably not, but still, going off historical performance, this one held up very, very good during the most recent recent recession, which is definitely worth something. The next single stock that held up very well during the most recent recession and is offering a smash buy opportunity as of right now, potentially, is UPS. One of the stocks I've been talking about a lot, and one of the stocks that have been beat up like crazy as of recently, offering a starting yield of 5.01%, which is much higher than the average 3.34% over the last 5 or so years. And even though ever since all the craziness with UPS's last earnings, I personally think that the dividend is probably less safe than it used to be, I still think UPS has a good chance of maintaining their dividend and slow raises from here. But again, maybe most importantly, UPS during the most recent recession actually maintained the dividend the entire time and also saw recession sales of minus 12.6%, which is average growth during this time frame, and recession returns somewhat close to what we saw the S&P have of around 48%. Now, where UPS is currently trading at, I'm not adding any more shares as of this second, but if we see a larger dip from here, I think UPS could potentially be too cheap to pass up at that point. I say this all to say that UPS is just another one to watch closely. It's potentially offering a buying opportunity, and it did maintain its dividend during the most recent recession. The last dividend growth name that also maintained their dividend during the most recent recession and a dividend growth stock that's offering a potential buying opportunity is Robert Half, RHI, or the Human Resource and Employment Service Company. Now, Robert Half not only has a very safe dividend as a 96 on the safety score, has 10% dividend growth, which is massive, but also Robert Half is offering a 3.39% forward dividend yield, which a 2.26% dividend is what investors were getting on average over the last 5 or so years. Now, even though Robert Half during the most recent recession saw a minus 54%, basically the same as the S&P 500 saw as far as recession return, a minus 34% in sales, which is honestly pretty bad. This is actually below average, but during this time frame, even throughout all that, Robert Half increased their dividend even during this time frame, which is impressive. Now, where Robert Half is trading as of currently in the low 60s, like I said, going off of historical performance, this one is also offering a potential buying opportunity and could be a dividend growth stock that you could buy into as of right now and get an initial massive starting yield, again, compared to historical performance. Either way, especially if you want some exposure into human resource and employment services, Robert Half is definitely one to have on your watch list. So those are 5 different single dividend growth names as of right now that are all potentially offering buying opportunities, but on top of that, every single one of those different stocks not only either maintained, but also even potentially raised their dividend during the most recent recession. Now, is there a recession coming? Is there going to be a slowdown in the economy towards the end of this year and in 2025? I personally think it's very possible. I think the Federal Reserve has to be very nimble and very careful on what they do here as far as cutting interest rates, leaving interest rates alone, but I think it's going to be very interesting to watch, and I think either way, we're going to see some massive volatility in the up and coming months. Now, just because a stock and ETF, whatever the case might be, raised their dividend during a recession previously, cut their dividend, etc., it doesn't mean that it's going to do so in the future. Historical performance does not indicate future performance, but going off of history does give you a pretty good idea of what happened in the past, of course, so it can give you an idea potentially what you can expect in the future. Now, all that to say that as of right now, for me personally, what I'm doing, because I personally think a recession is possible ahead, I'm investing a large portion of my cash balance daily into the SEHG ETF or other diversified ETFs that don't only hold 1 or 2 stocks. I want to have my entire portfolio as diversified as possible because I know for certain that there's certain names as of right now in my portfolio that if and when a recession hits, I'm going to see some pain across the portfolio. So if you can limit that and diversify as much as possible, you're going to be able to probably make it out the other side of the recession as unscathed as possible. But lastly, most importantly, I have a question for you guys down below. What is one stock, one ticker symbol that you think is not only going to maintain their dividend if we were to have a massive recession up ahead, but what's a stock that you think would make it through the recession with flying colors? Drop the ticker symbol in the comments down below. If you enjoyed this video, make sure to please drop a like and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.